There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone. Today we're going to talk about the difference between candlestick charts and candlestick patterns for stock trading entries and exits. The two are completely different. Now, if you have just been trading in the past few years, you probably have only seen candlestick charts wherever you go on the internet, because they are the most popular type of stock chart that there is today. A stock chart is a chart that diagrams the price, time, and volume activity of a stock or an index or an ETF or whatever that is traded on the stock market. There are charts for commodities, there are charts for currencies, for the Forex market, for the futures market, for options trading. There are charts everywhere because charts are a visual of what has gone on in the past with that particular stock, bond, commodity, currency, futures, whatever. And so it is important to look at charts. The study of a stock chart or a chart for a financial market instrument, because a stock is a trading instrument, a bond is a trading instrument, they are also long-term investments. But nowadays, more and more people are using them for short-term trading instruments. Whenever you have a trading activity, you're going to be trading the short-term action of the price, stock, up or down. We're going to use stocks today because it'll be easier to talk about it, but this applies to all of the trading instruments you might wish to short-term trade. A stock chart provides the information that has been going on historically up to the current day or the current minute of activity if the market happens to be open at that time. This gives you a visual of what has gone on in the past in relation to what is going on now. A candlestick chart is just one of a variety of charts that are available for stocks and other financial market instruments. Before candlestick charts were very popular, because they became popular in the late 90s, because Steve Nissen, who is the primary person who brought candlestick charts from Japan to the Western markets, wrote a book, and it became very popular because candlestick charts are the easiest of all the stock charts to read and learn to use. Prior to candlesticks, bar charts were the most popular, and there are open bar charts and there are different kinds of bar charts, but what the bar chart did is it had a line that was drawn, and you could see where the price opened, where the price moved up to an all-time high, also the low of that price, and the close. So you had the opening price, the high price for the day, the low price for the day, and the closing price of the day, which are all usually not the same. Sometimes the open and the close are the same. Sometimes the open and the close are exactly the same as the high and the low. It doesn't happen that often, but it does at times. So bar charts were the precursor to candlesticks. Prior to bar charts, when the greats of the stock market started drawing price and time action, because that's mostly what they're looking at. When they're looking at a chart, the top of the chart pretty much contains price and time for most of the charting programs. But before candlesticks in the 90s and before bar charts in the 50s, there were line charts. And it was Charles Dow, the man who invented the Dow Industrial 30, who actually created line charts. Other people were making line charts, but he made them popular. So we had line charts. They evolved into bar charts because line charts is only the close of that day. So it's a line that goes horizontally up and down based on what the stock or index did for that minute, for that day, for that week, for that month, for that quarter, for that year, for that decade. Depending on the time frame, the line moves up or down at the closing price for that stock or index or ETF or whatever for the time frame. Now, line charts are really designed for long-term investing, so we usually look at weekly line charts or monthly line charts or yearly line charts. We do not look at daily line charts because we now have candlestick charts, and before that we had bar charts, which gave us the open, the high, the low, and the close, which gives us 4 pieces of information that help us understand what the stock price did that day. And if we understand what it did, we can extrapolate from it who is controlling price and how they are planning to move the price in the near-term future, which is critically important to day traders, swing traders, position traders, and so on. But candlestick charts are not the only charting program that you can use. I've talked about bar charts, and they were the precursor to candlesticks, and a lot of places still use bar charts, but they're harder to read. I want to talk about point and figure. In between bar charts and line charts and candlesticks, point and figure charts were developed. The point and figure charts are not popular today as they once were, because point and figure charts were developed before computers, and they do not use volume and they do not use time. The most important thing about point and figure is it's all about price with no time. And that makes it very hard to read, and they're not as reliable as candlesticks or bar charts. Renko charts are a Japanese charting system that is very similar to point and figure, and it looks very similar to point and figure. The only difference is that it uses a different format for it. 3-line break charts are also a Japanese invention, and this is also similar to point and figure, that it doesn't use time within the price chart. So you have point and figure, 3-line break, and Renko charts that do not use time. Bar charts, line charts, candlestick charts all use time as well as price to formulate the chart that shows the price action. And this gives us a huge amount of extra information. There are also Kagi charts, which are very similar to the formatting of point and figure. They're very, very rarely used. Then we have 2 types of charts that include volume. Candle volume charts, which is the point and figure charts that also incorporate volume within the charts. And then there are equivolume charts, which use the candlesticks and volume to provide all of the data, price, time, and volume into the candlestick patterns. So there are more than just candlestick charts, and candlestick charts are a type of charting system to evaluate price and time, or just price, or price, time, and volume. So these are the different kinds of charting systems that are pretty much out there. There may be others, but those are the primary 9 different ones that you might find on the internet and read about. The reason that candlestick charts are more popular is it's very easy to use them. A white candle indicates the stock moved up, a black candle indicates the stock moved down, a very small candle indicates it didn't move very much, and they're just very easy for beginners and novices and everyone to use. Sometimes on the internet you'll have a green bar and a red bar indicating the up and down. This can be a little harder to interpret because our eyes are used to reading in black and white, but sometimes these are also popular, especially if people use the black background on their charting software because they think it's snazzy or fancy. I try to make it as easy as possible for my beginners to learn to read, and everyone learn to read with a white background with black text. Therefore, the white background candlestick charts with the black and white candles, the white candles being outlined in black and the black candles being solid black, make it far easier for a beginner or a novice to learn to read candlestick charts, and you need to learn to read them. Candlestick charts are very similar to how a musician reads music. So if you read music, you have an advantage. They're geometrical shapes, so if you're a mathematician, they will make complete sense to you. They have a very systematic way that they line up on the chart. But just learning the candlestick, black and white, doji, and all of the different Japanese candlestick terms from the original candlestick books is not learning candlestick patterns. The Japanese candlesticks that we use today, the basis of it, was for the rice commodity exchange of the 1600s of ancient Japan. Rice was also a currency in those days. So we had a commodity currency the Japanese drew charts of on price and time to evaluate the fluctuations of price of rice commodity, which is also a currency at that time. Commodities and currencies move extremely differently than a stock does. It's a completely different type of trading instrument. And so the price action and the time action on those varies greatly between a commodity or a currency and a stock. So what happens is that for commodities, it's a futures contract that's going to be made in the near-term future. For currencies, it's a trading transaction between countries or between institutions and global banks or between bank to bank to balance out the variables of global trade. So these activities are going to be very different candlestick patterns. And what I mean by candlestick patterns is how the candles form across the chart, how they move up and down, the size of the candles, the magnitude of candles in relation to the volume bars below it, and the large lot versus small lot indicators. Candlestick patterns in the Western market for the stock market are very different than the candlestick charts that the Japanese used in the 1600s for the rice commodities currency exchange. You will have learned, because everybody does, they read the candlestick things and you'll read about this is a reversal candle. This means that the stock might reverse. This is a continuation candle. This means that it might continue. You've learned a lot of terms. Haramari, doji, engulfing white, dark cloud, and so on and so forth. And that's great. It's the beginning. But until you learn the candlestick pattern formations, the trend line patterns that indicate, is this a dark pool buy zone? Is this pro traders' footprints coming in after the dark pool buy zone has started, moving price up slightly in preparation for the HFTs who gap and run stocks hugely? The Japanese candlesticks do not have the gigantic HFT gaps and runs at all. They didn't exist in the rice commodities, rice currencies, exchanges of ancient Japan. We have a lot of resting day patterns that are not in the candlestick books because they didn't form in the Japanese candlestick market. We have pro traders candlestick patterns, which don't show in the Japanese candlestick books or training that you've taken. We have the HFT patterns, which don't show in those books or the training. We have corporate buybacks, and there's a specific pattern for those. And right now, buybacks have been huge this year with corporations, and how the corporations buy back their own shares of stock leaves a different footprint on the candlestick chart. So when I refer to candlestick patterns, I'm referring to the footprint or the pattern that dark pools create, pro traders create, buybacks create, pro traders create, retail traders create, long-term investors, retail side create. All these different market participants have different order types, different routings. Some go to the exchanges. The dark pools use alternative trading systems that are off the exchanges, OTC. Pro traders have their professional routing systems. Small lot investors, small funds managers, retail traders all use the exchanges. HFTs are on the exchanges. So there's a lot of variables going on with order type, routing, quantity of share lots being traded, where it's being traded, venues that are hidden with dark pools where you can't see the activity until after the market closes. There's a lot of variables. This alters the way the candles form on the chart. Now, there are a lot of online training companies and online training seminars that tell you a lot, that all you need to do is learn reversals and continuation patterns and you're set to go. Really? The stock market is fully automated on the professional side. And on the retail side, your broker fills your orders, taking advantage of any spread they can get. And you think you can get a red light, green light trading system to work for you? Good luck. Highly skilled professional traders use candlestick charts. They also identify the patterns. They can see the dark pools because the dark pools don't move price. They set what I have coined a buy zone. That's my term. This is a bracketed area where they use their special order types and they say, buy me in at this price, but do not pay more than this price for the stock. So when the dark pools are buying in accumulation mode over extended period of time, the stock moves sideways in a fairly tight formation, not as tight as a consolidation and not as wide as a trading range. I call it a platform because the highs and the lows are extremely consistent. In a trading range, highs and lows are very inconsistent. These are all candlestick patterns you need to learn, and you haven't. You've just learned candlestick, fancy, complicated Japanese terms, trying to remember all of them that they are, and you know reversal and continuation patterns, and you don't have enough to trade and be successful. Oh, maybe you're making 10 cents on a trade, and you think you're really happy with a 10-cent trade on 100 shares, whoopie-doo-dah. But if you figured all the time that you spent and the true costs of trading, you would find that you were losing money on that type of thing. When you can see the candlestick patterns and you can identify the dark pool buy zones, you know that the pro traders are going to find that liquidity draw and they're going to very quickly start buying that stock in anticipation that whatever is causing the dark pools to accumulate will ultimately come out in retail news and cause the HFTs to gap and run the stock. So the pro traders get in right after the dark pools and sit and wait because they know that the HFTs are going to gap that stock and run it on retail news. Meanwhile, you find out about that news early in the morning. HFTs have already gapped and run it, and so you go and buy it at the top, don't you? Wouldn't it be lovely if you could see the dark pool buy zones, you could see the pro traders' footprints, that they're getting into that stock, you could get into that stock, and then when it gaps and runs, you can sell it right along with the pro traders and make money on that stock. A lot of money. HFTs are gapping stocks anywhere from 2 to 20 points right now. That's a lot of profit. Most of you leave it far behind. So candlestick charts are a type of charting system or program that you can have on your computer or your tablet or whatever. And brokers have very basic charting programs, and most of them have candlesticks nowadays. But it's the candlestick patterns, and I'm not talking about reversal and continuations. Those are not what I'm talking about. I'm talking about identifying the footprints of pro traders, dark pools, HFTs, smaller funds, corporate buybacks. All of these are very different because they have a different intent. They have a different purpose for buying and selling. They have different order types. They have different routing. They trade on different venues. Most of the activity nowadays is not on the exchanges. So if you're day trading in real time, you're trading on the minute scale, which is the only amount of time that the SEC allows you. That's the lowest amount of time. Everybody else is trading on the millisecond. There are trade transactions going on 60,000 times faster than you're trading. So don't you think you need to learn the patterns that these high-speed traders form on the candles so that you can trade with them rather than against them? It's very important to stay with the changes of the market. And what happens with a lot of these online training companies and these seminars is that they have been preaching this stuff forever, and they never revise what they're teaching. They never find out about market structure, and most of the people that are selling and instructing, because the instructors are all salespeople, have never traded in their life. They show you a little format. They show you how to enter a broker order. They show you how to use their trading system. They're salespeople. Ask them what their credentials are. Do they have a Series 87 from the SEC or a Series 86 from the SEC? Do they have a CFA? Do they have a CMT? Do they have any credentials whatsoever? And you're listening to them and trusting them with your money? I'm just asking. Candlestick charts are a type of charting program that you can see on your computer or your tablet or your laptop and use to study stock charts. They are just one of 9 primary types of charts that are available for stock analysis. They are the most popular because they're the easiest to use and learn. And you read them like you would read a piece of music or a formula or geometry or algebra. You have to learn the language. And it's more than just the Japanese terms for a certain candle. That's all great and wonderful. But that is not going to help you become highly successful in the stock market. You have to learn the candlestick patterns that are buy zones for dark pools. So you have the candlestick pattern for dark pools. You have the candlestick pattern for pro traders. You have the candlestick pattern for buybacks done by big banks for corporations. You have candlestick patterns for the super wealthy who have professionals investing for them. You have the candlestick patterns of small funds managers, the small funds. There's tens of thousands of these small funds, and they all trade the same way. You have the retail trader candlestick pattern. You have the retail investor candlestick pattern. You have the odd lot investor candlestick pattern. You have many, many different kinds of patterns that form on the candlestick charts. Those patterns are when each market participant group controls price at a certain level. And if you can recognize that candlestick pattern is a pro trader, that candlestick pattern is a buyback setup, that candlestick pattern is a dark pool buy zone, then you know how price is going to behave in the near term. You have a Bollinger Band squeeze or a compression pattern or whatever. You still don't know which direction it's going to break out unless you can recognize the candlestick pattern that tells you that that's a dark pool and they're accumulating, or that's a dark pool and they're distributing, they're slowly selling the stock. That's a pro trader and they're getting ready to buy. That's a pro trader and they're getting ready to sell short. When you can read candlestick patterns this well, then candlestick charts make a whole lot more sense. Think about it. And then come visit our website and see if we can help you become a consistently successful trader. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.